When it comes to deciding on a mortgage, you lock into a fixed rate, consider going variable, or think about a shorter term. Everything Financial's Peter Cishecki joins us with some things to consider. Good morning. This is on a lot of minds of a lot of people right now. Good to see you, Peter.
It is. Good morning, Carrie.
Okay, so a lot of people think about, what is the better rate? And I think typically people think longer term because that typically would have the less interest, but that's not happening right now.
No, right now, actually, and this is contrary to normal, the 1 year rate or the 2 year rate is normally the lowest. But again, you're in a very short period of time. Right now, the 1 and 2 year rates are actually higher than the 5 year rates. There's a method to this madness as far as the banks are concerned. So they're trying to entice people to take the long-term 5 year rates because they're lower right now, but are they less expensive?
So I guess this is where you kind of have to crunch the numbers. So if the shorter term ones are the higher rate, I guess they're doing this because they know that a lot of people are looking at those shorter term because they don't want to lock in long term.
That's exactly it, Carrie. And right now, if you look at the difference, and let's just use a $500,000 mortgage, the difference in your payment, even though the 1 year rate is higher right now, is going to be a couple $100. Here's the problem. What if rates go down as they are expected to? Let's say they go down next year to 4%, 4% the year after. That little bit of interest savings in year one from the 5 year rate is going to disappear in year two, and you're going to make money in year three if you hold out, stick 1 year, and if interest rates, in fact, do go down to about 4% in that 1 or 2 year mortgage rate.
So this is a case of where it doesn't necessarily pay, so to speak, to go with the lower interest rate.
That's right. It's deceiving. It really is, because you're looking at a rate, and a lot of times, and I've seen this where, well, over the next 20 years, look what the rate difference is going to be and how much you're going to pay in interest. Well, we're not talking about the next 20 years, Terry. We're talking about the next 12 months. And the difference is, and again, like I said, I did a $500,000 mortgage for this episode, which I think is a one-car garage in Vancouver. But anyways, and it's not a significant difference. I would flip the coin and take the 1 year and wait and see what happens, because the indications are we're going to get lower rates in the very near future.
Okay, so the indication is, you said maybe in about a year. What if those rates don't go down?
Then you took a gamble, took a chance if you took the 1 year, and you spent a little bit more money than you would in a 5 year. But if you're not sure, wait a week and see what happens with the April inflation numbers when we get them, because if they have a significant reduction like they did in March, which was, remember, 0.9%, then that's kind of a sign of things to come. You've got to remember too, banks are already lowering term deposit rates significantly as a sign of what they're going to be able to collect on that money in the future. All the signs are there. Inflation will be the next one in the next week when we get that number. And I mean, right now, all those interest rate increases that started last March are now starting to affect inflation. So I would hold out and take the 1 year. And again, the payment difference on that $500,000 example is not significant.
And what about variable versus fixed mortgages right now?
The variables are still high. They're usually the best way to go with, for the most part. They're still high. So that way, a 1 year as well buys you time for those variable rates to come down as well in the near future. So 1 year just gives you complete flexibility and prevents you from making a change in a year or two that can cost you thousands of, and I mean thousands of dollars in fees if the rates go down significantly and you want to go from that 5 year because you bought into the fear, oh, I better get that 5 year, I have to be extra safe. And It turns out, what if you made the wrong decision?
Lots to consider. Boy, not an easy decision. Peter Cishecki with Everything Financial. Thanks for your insight this morning. We'll talk to you next week.
Thanks, Carrie. We'll see you next week.